Hello. Thank you all for standing by. My name is Brent Sanja from the Department of Agricultural, Environmental, and Development Economics. On behalf of my colleagues on the Ohio State University Climate Change Outreach Team, let me welcome you to today's installment of our monthly webinar series. We're delighted you're with us for the presentation by Bruce Brain from American Electric Power titled The Future of Energy and Climate Change Policies. These webinars are an initiative of the Ohio State University Climate Change Outreach Team, a multi-departmental effort within the university, led by OSU Extension, Ohio Sea Grant, Bird Puller Research Center, and a number of other departments at Ohio State. Before introducing our speaker, let me note just a few logistical issues for the webinar today. During the entire webinar, all participants will be in a listen-only mode. We encourage you to ask questions via the chat feature located on the right-hand side of your screen. Simply type in your questions and send it to the entire group, or you can go ahead and send it to me. Send those questions at any time, and we'll collect them. And at the end of the webinar, we'll ask them to Bruce, and he'll provide answers via discussion. So we'll basically collect all the questions via the chat feature from you, and I'll ask those to Bruce at the end of the webinar. We have more than 150 participants on this webinar, a great diverse group representing governmental agencies, academia, and nonprofit groups from around the country. Please keep those questions coming throughout the presentation, and we'll remind everyone on the chat feature throughout the presentation to send in their questions. This webinar is being recorded. It'll be posted onto our website for later viewing. Also, we'll post a webinar survey in the chat feature towards the end of the hour. Please take a few minutes after the webinar to fill out that survey. That will help us continue bringing better and different webinars in the future. Now let me introduce today's speaker. Bruce H. Brain has been a Vice President of Strategic Policy Analysis of American Electric Power Company Incorporated since 2001, where he is responsible for the analysis of federal and state energy and environmental policies, as well as analyzing and assisting in the development of long-term environmental and energy strategy. Mr. Brain was formerly Senior Vice President of Analysis of American Electric Power Energy Services and Senior Vice President of ICF, where he directed the company's electric utility consulting group. Mr. Brain currently serves as the Vice Chair of the Board of Directors of the International Emissions Trading Association. He is a former board member of the Chicago Climate Exchange and of the Ohio Association of Nonprofit Organizations. Mr. Brain holds a bachelor's degree from Brown University and a master's degree in business administration from Stanford University. And I know from several times of listening to Mr. Brain make presentations that he does a fantastic job on this topic and many others. We're delighted to have Bruce Brain with us today to speak about the future of energy and climate change policies. So, Bruce, I'll turn it over to you.
Oh, thank you very much, Brent. I really appreciate that very nice introduction. What I'm going to try and do today is give you a bit of an overview of U.S. climate and energy policy issues, particularly focusing on the former, and give you my perspective on what I see as coming sort of future developments in this area. Per usual, any of these opinions I may express are those of my own and not necessarily those of AEP. Let me start out by giving you a little bit of background on AEP. AEP is a large coal-fired, predominantly coal-fired electric utility. As you can see from the map, we serve about 11 states across the middle section of the country. We have a large amount of generation. We're the third largest generator of electricity in the U.S., one of the largest transmitter and distribution companies, as well as retail electricity providers. One of the facts of particular importance. One of the facts of particular importance. Are you hearing me okay?
Yes.
Yeah, okay, I'm sorry. My phone just re-rang for some reason. I'm not quite sure why, but let me continue. Anyway, one of the important factors for us and why climate policy and energy policy is so important is we're a large emitter of CO2, as well, being one of the largest coal-fired electric utilities in the United States. One of the parts of our strategy, though, moving forward, is to move to a greater diversity of fuel. We'll be increasing natural gas and particularly our renewable energy such that coal will really account for about half of our generation and capacity by 2020. All right, well, starting out with a little bit of broad background on the climate change issue, clearly the most significant global environmental challenge that we face today. This is a chart, a little bit busy, so you'll have to bear with me a bit, but provides looking at some of the scenarios that many of the economic modelers have looked at going forward in the future, and that the impacts of these various scenarios on temperature increases. The red line across indicates 2 degrees centigrade. That is the level in which many scientists feel is important for the world to keep those temperature increases to avoid some of the more potentially dangerous effects of climate change in the long run. One of the things, though, that is evident as if you look at the chart is that the reference cases, and I think that sort of the most likely bound of those reference cases is the black line on the top, and the red line that runs out over time. As you can see, that gets you to more like 3.5 to 5 degrees centigrade estimated by 2100. And the current pledges, and a lot of these were made beginning in the Copenhagen Conference of Parties back in the end of 2009, but certainly with the Durban meetings in 2011, those pledges will have an impact, as you can see, relative to that red line, assuming we're on that scenario. But unfortunately, it's not a huge impact, and a lot of that has to do with the context of what emissions are most critical in causing climate change or in resulting in these kind of temperature increases. And unfortunately, a lot of it is now coming from the developing world, as we'll talk about in just a second. Put this in also in another context. Many of you may have followed what happened in the news relative to the meetings in Doha, Qatar, that just completed the end of this past week. Those meetings have focused on trying to make more progress on the long-term commitment track, which would involve presumably at least all the major countries in the world. But it's still a long ways from making real progress in getting major reductions or major pledges, particularly from major emitting countries like China, India, and other developing countries. And there's a lot of issues around how that gets paid for, that type of mitigation. There was a fund that was set up for $100 billion to be sort of funded by a lot of the developed countries, including the United States, and many of the European, Japan, etc. There is no agreement on how to reach that level of funding at this point. On the other hand, there were some positive things that came out of the Doha meetings, although a much smaller part of the picture these days. The Kyoto Protocol, which covers now about 15% of worldwide emissions, it's largely Europe and a few other countries around the globe. It no longer, unfortunately, includes Russia, Canada, or Japan, who have all withdrawn from the Kyoto Protocol in terms of reduction requirements. But at least there was progress in getting agreement on the second commitment period, which would involve reductions starting now and going out to 2020. One of the things that I mentioned, certainly in providing context with our sort of broad global environmental challenge, is the fact that the developing countries are playing a very, very significant role moving forward, and even in more recent history in terms of the growth in emissions. This is a chart that just shows the total growth there on the bottom, which is 11 gigatons, 11.28 gigatons, which is again, gigatons is in billions of tons. You'll note that China accounts for the vast majority of that, and other developing nations, if you sort of add the other two bars above there, really is accounting for all of the net growth. In the rest of the world, which is the developed world, we've seen reductions in emissions in a lot of the Russian economies in transition, which are having a lot to do with the fact that the Soviet Union broke up in 1990. We had major economic contraction in Eastern Europe and Russia until more recently, when we've obviously seen more growth in those countries. You've seen some growth in the developed countries outside of the EU. The EU has fallen in part because of the Kyoto Protocol, which has resulted in emission reductions in Europe. And then, of course, you see some growth in the United States. But as you can see, it pales in comparison to what is now going on in the developing world. And if we look sort of out towards the future, and this is an estimate, there are a whole series of different estimates. This is one of the more, what I call mid-range estimates of what will happen to energy-related carbon dioxide emissions. And you can see that while today China, India, the rest of Asia, a lot of the other developing countries around the rest of the world are accounting for something like 2/3 of emissions or so, that growth means that it'll increase to more than 3/4 of emissions a little bit past 2020, and by 2050 you're talking about literally 85% of emissions will be coming from the developing world. The U.S., Europe, Japan, when you combine sort of some of the commitments that already have been made, but largely due to the reductions that are occurring already in the marketplace in these countries, those emissions are going to stay relatively flat. So turning to the U.S. And really focusing on what are the issues in the United States with respect to greenhouse gas emissions. First thing to point out is I'm going to be focusing virtually all my remarks on carbon dioxide. As you can see from the graphic on the left, that's 84% of the total greenhouse gas emissions. I don't want to neglect totally, though, that there are other greenhouse gases, the remaining 16%. The two most important of those are methane, or CH4, and nitrous oxide, or N2O. Those occur from a variety of sources. The big one is landfills, as well as livestock manure produces a lot of methane, and leaking in gas production facilities or even in gas pipelines produces really the remainder of those methane emissions. The good news about those emissions is there actually are ways to cost-effectively reduce those emissions, and by that I mean at a fairly low cost equivalent. Tend to be much cheaper than the options to reduce CO2 emissions. So we will see some activity in those areas as we move forward. But with respect to CO2, you can see from the graphic on the right that more than 60% comes really from two major sectors, transportation and electric power plants. Industry is an important emitting source, and even commercial residential facilities, that's obviously largely the use of natural gas for heating, is an important player as well. So with respect to U.S. policy, a quick bit of background. We had economy-wide legislation that on climate that actually passed the House of Representatives in early 2009. This was the Waxman-Markey bill. However, that failed to, sort of a companion bill, failed to pass the Senate, and in effect, the whole effort basically cratered in 2010. There was a good deal of Republican opposition, even some Democrats who were opposed to the bill. And I think that what really undid the legislation was the fact that there were large concerns about the economy, and remain the same kind of concerns given the relatively slow growth that we've seen. At the same time that this activity was going on, President Obama made commitments at the Copenhagen meetings. That was one of the Council of Parties meetings, the COP meetings, in December of 2009, to reduce U.S. emissions 17% below 2005 levels. And that would have been in line with the Waxman-Markey bill, but of course the bill didn't pass. So it obviously seems at first blush that it'd be pretty difficult to attain without legislation that would drive that effort. However, as we look sort of at history first, we see that although U.S. emissions have been climbing around 2007, they have started to fall. Some of that, or a big part of that, certainly occurred during the recession in 2008, 2009, as you can see from the graphic. But even after that, although there was some increase in emissions in 2010, we've seen reductions in 2011, and so far in 2012, it appears emissions will be likely lower than 2011. So that raises the obvious question: that's what's going on, and clearly there have been a couple of key players in this overall sort of dynamic. One has been the economy, and the fact that the recovery has been less than robust. GDP growth is significantly lower than it was back in the early part of the 2000s, or certainly in the 1990s. I think the second factor is that there has been a virtual sort of sea change in the natural gas markets, where due to shale gas, we have much greater supplies of natural gas, and that has led to lower prices of gas generally, although they've picked up some in the last 6 months, still much lower than we saw in the early 2000s. That's led to some switching on the parts of not only industrial plants but also electric utilities because of the market forces of gas being actually a cheaper option. And I think there have also been programs in place, such as energy efficiency programs at the state level, as well as renewable portfolio standards at the state level, which have driven growth in non-fossil sources of energy as opposed to fossil fuels. And as you can see in this next graphic, it describes some of this. One of the other areas that I did not mention is the CAFE standards. This is the corporate average fuel economy standards. Those have been in place for a number of years, and in fact continue to drive at least a slowing of the growth in transportation emissions, and now I think as we'll look in the future, a turnaround of where the transportation emissions will be turning down significantly. The downward trend we expect will continue. This is a graphic that shows actually a whole series of scenarios that have been run by the Energy Information Agency, or EIA. They have the AEO scenarios. That's their annual energy outlook. And if you just focus on the 2013 chart, you'll see that the trend, or some ups and downs, with increases you saw in 2010, but generally the trend is downward between then and 2012, and even further downward by 2016. We expect by 2020, based on at least this scenario, that emissions would be 9% lower than 2005 levels. As you can see in the bullet point, There's a range of possibilities out there. It really will depend some on economic growth, some on some of the potential changes we'll see in regulations, as well as the markets for natural gas that could result in a decline of anywhere from 4 to 16%. My own view of this and sort of my own estimates is that, if anything, we will probably see a greater decline than the AEO number, maybe closer to that 16% level rather than a less of a decline than the 9 or 10%. The drivers, somewhat already talked about, the tepid economic recovery. There are very few economists who see a return to more rapid growth that we had last decade. I think the continuation of state renewable and energy efficiency standards, I'll talk more about those in a second, as well as state and regional CO2 programs. Again, I'll also focus a little bit on those. And forthcoming EPA regulations on CO2, as well as the impact of EPA regulations on other environmental issues in the utility sector, will be having an impact on CO2 emissions. And finally, shale gas and the potential that gas prices, as most people expect at this point, will remain reasonably reasonable prices that will allow for greater usage. If we look at the situation around the country as far as individual state requirements, this is a graphic showing the various renewable mandates around the country. Those in red are actual standards. By that, it means that those are binding requirements in state law, so they will be met. You can see here in Ohio, we have effectively a 12.5% requirement by 2024 for renewables. That will move Ohio into a significantly greater level of renewables than today, as one example. And you can see the variety of other states that have all sorts of different standards. Many of these standards also include credit for energy efficiency in terms of reaching the overall goal. But either way, the effect of this is to push more electricity generation away from fossil fuels and towards either renewables or energy efficiency improvements. If we look at the programs at the state level or regional level that impact greenhouse gases directly, we have really two major programs in that respect. We have California, which through its act, the AB 32, have a cap-and-trade rule in place that requires reductions of greenhouse gas emissions, and more specifically CO2 emissions, and that will make a significant dent in California's emissions. And we have the Regional Greenhouse Gas Initiative, which is a utility-only program. As you can see, it involves most of the northeastern states, although Pennsylvania never really joined, only was an observer, and is not part of the system now. And New Jersey recently withdrew from the program. Overall, these two programs will yield some reductions. I don't want people to get the wrong impression that they'll be very large in the context of the U.S. total. Keep in mind that the RGGI provisions, for example, are utility only. They don't cover transportation or industrial or other sector emissions. And then furthermore, the utility emissions in the RGGI states are already very low. So you're talking about reducing a percentage off a pretty low number, largely because those states use primarily nuclear, hydro, some renewables, and natural gas for power, as opposed to coal-fired power. And the same is true with California, although at least the California system covers other sectors other than the utility sector. EPA regulation, obviously, can take many forms, and it is taking form. One of the big events of the last couple of years was the agreement in the automobile industry to really push the corporate average fuel economy standards, or CAFE, up to a very significant level of efficiency to 54.5 miles per gallon fleet-wide average by 2025. That is actually for light-duty vehicles and passenger automobiles, not for heavy-duty vehicles. But nonetheless, it's a very significant improvement in fuel economy, and will have an impact on CO2 emissions from that sector. We also have permitting and performance standards for power plants and other industrial facilities under the Clean Air Act. That'll affect both new sources, and EPA has already proposed a new power plant rule. Most of us expect they will finalize that rule within the next few months, and that will result in limiting at least the potential emissions of new sources. The bigger question will be what EPA decides to do with existing sources. It is likely they will propose something for existing power plants, but it's not clear yet what level of reductions that will ultimately require. And I think the third area, and not to forget, is that the last couple of years, EPA has proposed and finalized a number of environmental regulations that drive, specifically in the electric power sector, which will drive and are already driving coal-fired plant retirements. Again, when coal-fired plants retire, they'll typically get replaced. The energy will typically be replaced by natural gas, and will result in significantly lower emissions as a result. In the sort of future broad policy level and policy options that really won't be able to be implemented vis-a-vis regulation, but would have to take a passage of law in Congress, there really have been three areas that have been discussed in varying degrees as far as CO2 goes. One is a carbon tax. A second is something called a clean energy standard. And the third is cap and trade, although it appears unlikely that any of these three would pass Congress in the next 2 years, and more than likely not even in the next 4 years. However, I never say never in this business, and in the policy world, things can change and sometimes change quickly. But I think the general consensus is we're unlikely to see any broad U.S.-wide policy option involving carbon that needs to be passed out of Congress. Having said that, though, let's talk a little bit about these options in case they do potentially get more serious discussion going forward. We've seen a discussion really more at academic levels. We've had a number of universities, think tanks, and others who have focused on the impacts of a potential carbon tax. You know, part of the interest has been the fiscal cliff discussions and the U.S. debt issues going forward, and carbon tax being a way to raise revenue. Most people, when they talk about a carbon tax, they talk about a fee on the use of all fossil fuels based on the carbon content, and that, the numbers that have been discussed are anywhere from, I've heard $15, $20, $25 a ton of CO2. You can see that could raise a lot of money over time. $100 billion a year is certainly not nothing to sneeze at in these days of trying to cut our deficits and get our debt under control. One of the issues, though, although it is a potential source of revenue, it really has a few pretty serious disadvantages. One of them, obviously, is that anytime you raise taxes, and particularly when you raise taxes on energy, and energy is very significant in sort of powering the overall economy, it's a negative. The second problem is that unless you make a lot of changes to it, fundamentally a carbon tax is regressive in nature. And by that I mean a lot of people will be paying relatively close to the same amount of dollars in CO2, either through their electric bills or through their natural gas bills, as people who are considerably wealthier than they are. It's almost like a flat tax to some degree. And then the third area is there's a great deal of uncertainty regarding the climate benefits. If you put in a $15 a ton CO2 tax, you might get 5% reductions, you might get 10%, you might only get 1%. Hard to know, and obviously that doesn't make it a preferable solution if you're trying to go at a particular goal with a particular goal in mind. Really, the second area is the Clean Energy Standard. In 2011, the State of the Union address, President Obama talked about getting 80% clean energy by 2035. During 2012, Senator Bingman, who is retiring from the Senate, decided as one of his last official acts was to actually introduce legislation mirroring the president's pledge of getting to 80% clean energy. The way in which Senator Bingman's bill works, and I think the way most people envision this, is there would be a carbon intensity of electric output based target. So in other words, you would have to achieve a certain amount of reductions by either shifting to wind or solar, which would get a full credit because they would involve obviously reducing the emissions to zero carbon intensity in that case, or natural gas would sort of get a half credit because when you shift from coal to natural gas, you reduce emissions in roughly in half. So that was the concept of the Clean Energy Standard. By increasing those targets, there's an incentive, obviously, to utilize and deploy lower carbon generation and displacing higher emitting sources as coal. EIA did an analysis of this, found about a 44% reduction by 2035, which is pretty sizable. There are similarities to the Clean Energy Standard, which includes the flexibility of hitting an overall target and allowing these credits to be traded, much like a cap and trade system where emissions are capped and then there's trading allowed among CO2 emissions. The issue with a Clean Energy Standard, though, is that you get into the regional distribution of the requirements. Clearly, if you had one standard, and people have talked about setting differential standards depending on which state you're in, but starting with the notion if you had one standard that everyone had to achieve by various points in time, there would be some states, take the state of Washington, for example, which gets almost all its power from hydro, that would have to do effectively nothing. In fact, it would get credits and would be able to sell them to other states and earn revenue out of the program, while there'd be other states like Ohio, which have a high amount of coal-fired electricity. They would have to do a lot, probably have to buy a lot of credits, and they would pay a lot more in terms of higher electricity bills and other costs in the state. So that's one of the drawbacks. Obviously, you can make changes in the standard to accommodate some of those concerns, but at a broad level, that's one of the difficulties. Lastly, there's cap and trade. This is not really being mentioned at all today in Washington. I put it out there simply because ultimately it's probably the most cost-effective way to go to get emission reductions. It most directly gets at the issue of CO2 and allows you to actually establish a cap in line with the level of reductions that you want or need. But there was a lot of negative backlash. You can see from this figure that one cartoonist made considerable light of it. There was a more nasty backlash during a lot of the debates in late 2009, in the summer debates of moving forward legislation and starting to try and move Senate legislation forward. It got tabbed as cap and tax, and calling something a tax in Washington is a good way to create negative backlash. So, really, in conclusion, I think what we're seeing going forward in the U.S., at least, is near-term CO2 reductions. That's partially going to occur through EPA regulation, mostly through EPA regulation, not so much of CO2, but of the other environmental issues which are pushing many retirements. The second reason, though, for those reductions broadly are market factors. We're seeing a lot more abundant natural gas, which has pushed already a switch from coal to natural gas in the power markets. State energy policy will also play a significant role. We saw a lot of renewable and energy efficiency standards earlier in the graphic. Ultimately, though, while this, I think, could get us a long way towards the goal that we need by 2020, or the pledge that President Obama made, post-2020 is probably going to require legislation. It will be difficult, we think, to get it all through EPA regulation, and in fact, there are many issues with using EPA regulation to get CO2 reductions. Simply put, the Clean Air Act was never written with CO2 in mind, and given that, there are a lot of challenges in getting a legally enforceable system in place to significantly reduce CO2 beyond 2020. Clearly, though, broadly, I think the critical issue for climate change is going to be dealing with the developing world's very rapid growth in emissions. As I mentioned, by 2025, already will account for more than 3/4 of CO2 emissions. That is really the critical area for making real progress on climate, and will be a challenging one as we go forward. And with that said, I thank you very much for the opportunity to present today.
Fantastic. Thanks a lot, Bruce. We really appreciate it. We do have a number of questions here and plenty of time for questions, so appreciate you leaving time for that. And of course, the audience will be clapping. You can't hear them, but they're out there. So I'm going to go and start kind of from the beginning. We've got a lot of questions here, and they're actually still coming in. So I couldn't figure out a better order than just actually going through them as they came in. So let me start with the beginning. And the first set of questions, two questions actually, had to do with infrastructure issues, and they were related to two things. One is climate change itself and the implications of climate change, storms, ice storms, hurricanes, etc., on the energy infrastructure, and the ability of companies like yours to restore the power after those happen. And so, the interaction between the two. Do you guys foresee big infrastructure investments, given the potential for climate change itself? And then there was a related question related to the climate policy issue. Was are these similar kinds of investments that you would need for adapting to new policies that require smart grid and all these other things that would help us with mitigating climate change?
Well, let me start with the science question first, and really and infrastructure investment needs. One point to make off the bat is I'm not a scientist. I'm an economist by training, and focus on those types of issues. But I would say that clearly it is an issue that we have to address just broadly. In addition to mitigating emissions, adaptation to changes in climate will be very important going forward, and not certainly just for electric utilities here in the United States, but around the world. We don't know exactly what the impacts are going to be. There's some scientists who think that, for example, with storms, that you may see more storms and greater severity of storms. Others think you may actually see less storms, although there's generally more agreement that you'll see more severe storms. But having said all that, as an industry, the power industry has to focus on a lot of its infrastructure and keeping its infrastructure sound and in place. One of the challenges will be, and this is particularly true, obviously, for many of our utility neighbors, not so much AEP because we don't serve too much coastline, only a little bit in South Texas. But for many of the facilities, obviously, along the Atlantic seaboard that got really hammered by the last hurricane, what do you do to help prevent a lot of the massive blackouts that you had due to the storm. Unfortunately, there's only probably so much you can do before you get into the whole question of burying power lines underground. And while people are very excited about this issue now, typically what happens is when it comes to the utility going to, and really all the wires business and the utility business is regulated, state regulated. So utilities will have to go to the state regulators and say, we want to make the following improvements, lay many more lines underground, and this is what it's going to cost, and the bill is very high. And so oftentimes, anytime those have been considered, people say, no, it's just too expensive. Will it change with the most recent hurricanes? Perhaps. I'm a little skeptical. I think people will probably not do as much. There are other mitigation measures that have been talked about to deal with just the general flooding that's not in the utilities bailiwick, which, we might see some of the utilities in some of the states like New York and others, New Jersey, trying to make those kinds of changes. And I spent so long on that question, I confess I've now forgotten the second part of that question. Policy prescriptions?
Yeah, it was more, that was kind of, it's a related question, but, some of the policy prescriptions for climate change might require new infrastructure, e.g. the smart grid. There were some questions about the smart grid, so maybe you could comment a little bit about where you guys are in terms of thinking through the smart grid questions and how that'll help meet some policy regulations, and then how relate that back to the infrastructure question.
Well, we're very, we've been pretty active in a series of pilots and getting some smart grids within our service territory established. There, again, the issue is money up front. It's something that involves upfront cost, and because of that needs recovery in various rate commissions. And we sort of had a mixed bag there. There were some commissions, I would say actually more commissions, who've typically looked at it and said it's kind of expensive and we don't want to move forward with that. I think the potential is there that a smart grid will make a huge difference in the long term towards making our system more efficient, therefore lowering the effective emissions of the system. It'll also make it more economic for people in the long run, I believe. But having said that, it does face some significant hurdles of trying to get sort of the upfront recovery you need to invest that capital.
Great. Yeah. So just kind of staying on that same vein, you mentioned it a couple of times in terms of the rate commissions and whatnot. I mean, there were several questions about PUCO in here related to their stance on how they're going to react when there's if there were a whole set of new federal regulations. So, I mean, is this is a big issue, isn't it? The fact that if the feds really do some drastic climate change policy, there also has to be state level, probably pretty big changes in state level policy, don't there be? Would that include PUCOs allowing a lot more flexibility in pricing, et cetera, et cetera? I mean, what do you see with the state level policy adaptation to the feds?
Well, it's obviously going to vary depending on where you are in the country. I mean, there are some jurisdictions that are deregulated. So, for example, in Ohio, on the generating side of the coin, AEP is phasing into full deregulation of its generating facilities, and that is going to happen quite soon based on sort of the current schedules. When that happens, you'll have as well Duke and First Energy. The state generation from the power markets will be completely deregulated. So if the federal government put in place, let's say, a carbon tax or a cap and trade bill, what that would do is it would require various reductions to be made and there'd be various costs, and that would have to be recovered in the marketplace. It would not be recovered at the state level. Now, there would be, as we talked about smart grid, potential investments that you could make at the distribution and transmission side of the business, which is regulated, and then that would have to be recovered through the commissions. And again, that might be challenging. Again, it will depend, I think, primarily on the economics of it. I mean, I think the commissions will look at it and say, is it better to, lower emissions through the generating side directly and recover in the market, or are there options at the regulated end, from distribution efficiency, let's say, that will do that more cheaply? And so I think that's really what the basic framework's going to be.
Great. So just kind of moving on to maybe a couple specific questions related to some of your slides. One of the questions related back to I think it was the pie chart where you had CO2, and the questioner I think was asking about whether those were, if you could just comment on the fact that the carbon dioxide equivalency. I think those slides are probably in carbon dioxide equivalency. This is when you have the different gases.
Yeah, they are, and then I should have explained that up front. Methane is like 23 times the global warming potential of CO2 emissions. So literally, a ton of methane is equivalent to 23 tons of CO2 equivalent terms. But yes, it's all done in equivalent terms. All those gases, as a matter of fact, N2O as well, and the CFCs all have much higher global warming potentials than CO2, which is part of the reason why, as I mentioned before, we shouldn't ignore those gases simply because you clean up a given volume of those gases, reduce leakage of methane, for example. There's a lot of bang for the buck because, simply put, it has a very high global warming potential that impacts the atmosphere much more than the equivalent amount of CO2.
Yeah, so that would, there was another question about whether or not a strong methane program or big methane program wouldn't be a better thing to do right now, and I guess you would agree with that this is a important thing.
I would. I think, the problem always ends up being how you get that done. I think it would be hard to do it except through legislation right now, although there could be, as EPA goes forward on regulations, there could be some requirements. For example, one that's possible is that in the natural gas world, we might see requirements as related to fracking for gas and how much methane leakage was allowed. However, I would say, generally speaking, there's a pretty strong incentive already for people doing fracking to try and get that leakage down to as absolutely low as possible, because they're basically leaking away with something that they're selling in the marketplace.
Yeah, so in that case where they have actual profit they can make from it, they have the incentives, right, to minimize that.
Yeah, they already have the incentives. I think where you find some interesting dynamics are in the area of manure, which is in these sort of lagoons at farms and and your basic livestock industry, and there isn't any real incentive to do a lot with it. There are a lot of advantages to actually deal with the manure, get rid of obviously the leakage from the manure, recycle it in some cases, and you also have a lot of other side benefits related to water pollution and all sorts of other pollution problems with these, particularly again, these livestock type farming or operations. And the same is true for landfills, but to a lesser extent. Landfills, by and large, are operated, by state and local governments. So there's opportunities to at least flare the leaking gas, which reduces, enormously the global warming potential.
Yeah, I think that's exactly what the kind of information the question was seeking. But just one more specific question before we go to some general ones again on your slides. There was the 80% clean energy by 2035 pledge. Does that refer to electricity or all energy sectors?
No, that was just electricity.
Okay. All right. And broadly, there were a couple questions related to the potential economy-wide effects of some of these regulations. And so one of them was really just kind of blunt here, saying, 5 years ago it seemed like we all talked about climate change, then everything became jobs. I mean, are you seeing a shift back towards discussion of, climate change as a primary driver for energy, or is jobs going to be the primary motivator for energy in terms of policy?
It's a tough one to call at this point. I think as long as the economy remains fairly weak, as it still is, and we have a fairly tepid recovery, I think jobs will still be a big issue. Although the unemployment numbers have moved down, the part of the problem is and getting a little off the field for climate change for the moment, but part of the problem in the jobs picture is that what is referred to often as the underemployment rate is still around 14-15%. And when you factor in the fact that increasing number of jobs are now part-time as opposed to full-time, sort of full employment becomes a big issue. Clearly, it's driving the way the Fed is acting with respect to the money supply, and so it's likely that jobs will still be a very important issue as if and when Congress starts to really seriously consider a climate change bill. I think what that means, translated, is that as we see any potential climate legislation, that the focus will be on trying to come up with solutions that are not harmful to the economy, or at least minimize that kind of harm.
Great. Now, a related question was about, well, I don't know how related it is, but it's about the sort of energy. There has been discussion recently in Ohio and other states about potentially trying to roll back some of these renewable portfolio standard regulations. I mean, you had the map up that had all the RPS standards across the country. I mean, do you see those as viable? I mean, that might be too specific and too hard for you to answer, but do you see that as viable? I mean, is there a realistic effort to roll some of these back or even eliminate some of these renewable portfolio standards?
There have been some, and obviously you mentioned Ohio, and that's clearly one of the states where that's been talked about doing. It's often pretty hard to roll back standards that are currently in place. You obviously need the votes to do it, et cetera. But I think maybe in some states we'll see that happening. I think for the majority of the states you will continue to see the kind of standards that you have there. One of the big issues, though, and it's something that we'll all have to come to grips with, is as these standards bite more and more, in the sense of they become 20 or 30 in some states of electricity, and we have the likelihood that a lot of the subsidies for wind and solar and the like for electricity production are either eliminated or phased out, and I think one of those two is the most likely scenario. It's unlikely that we continue to have the same level of a production tax credit that we have today, out 5 years from now. As that all happens, that's also going to change the economics of renewable energy, and there will be some pressure because it will start to drive up electricity rates more, and either in the marketplace drive up rates, and the combination of all those things will perhaps lead to some reconsideration in some of the states.
Interesting. Yeah. You can't avoid the topic with climate change and electricity. The question of nuclear came up. What's your thought on that? Is it viable?
Well, the big problem with nuclear right now, relative to really other electricity generation sources, is that it's very expensive. You're looking at some of the estimates that people have had for new reactors which are sort of all in the planning stage right now. And to the extent they actually occur is another whole question. And nuclear is more expensive, significantly more expensive, for example, than building a natural gas combined cycle plant for new electricity. Is more expensive in most cases for building a coal plant. And I would say coal plant is significantly more expensive than building a gas plant today. So I think the big challenge for nuclear, although certainly there are issues about acceptance of nuclear and some of the concerns about accidents and what happened in Japan, obviously, but I think the bigger issue right now is, or hurdle is the economics. I think there's got to be some reductions in the cost of building nuclear plants for them to really be economically viable. However, and understanding this, in the very long term, if we're looking for as large reductions as people have talked about, for example, by 2050, you're going to need a lot of sources of non-emitting generation, and it's going to be hard to get there with just renewable power. You're probably going to need a lot of nuclear power in the long term.
Yes, I assume you guys have done the kind of analysis that would need to be done to look at what, for example, Ohio would need to do to be, to achieve an 80 to 90% reduction in carbon dioxide emissions by 2050, which is kind of what Waxman and Markey wanted to do and what the discussions at Copenhagen were kind of aiming for.
Yep.
What if you were to just sort of guess at the percentages of different power sources that you would need and that would be economically viable by 2050? What would be your guess?
Well, I think that I think you almost have to be talking about a combination of obviously a very significant amount of renewable energy, a lot of continued major improvements in energy efficiency across the spectrum, and a lot of nuclear plus probably coal with sort of hopefully by then carbon capture technology is what you would have to have. And then even some people have talked about, one way to get to those kind of goals is to actually have negative emissions, and that involves doing things like biomass for electricity, and then capture the CO2 from the biomass and store it underground, so that you're effectively in the system terms taking CO2 out of the system as a negative emissions. Those are all very challenging things right now, and hopefully as we move forward in the next 5 years, the prism of how to get there will become clearer. But I think it's going to be one of those all of the aboves. It's not going to be one technology that's going to get us there. It's going to be a lot of different technologies.
Well, fantastic. I really want to thank you. This is the at least of the webinars I've been involved in, the longest time we've had for a question and answer. And we had really a ton of questions. Actually, we have more questions here than we could ever ask. Your presentation brought on a lot of questions, and I appreciate your leaving the time for us to get to a lot of them. And I apologize to people for whom we didn't get to the questions. I want to thank again Bruce for his outstanding presentation. I also want to thank the Ohio State University Extension, NOAA, and the National Sea Grant College Program for funding this webinar. Sea Grant does a fantastic job of putting these webinars together, and all of us here really appreciate everything that they do in that office to make these things work so well. I did want to remind you that our survey URL for the webinar is in the chat feature. Please take a few minutes to fill that out. That's really helpful. That will help us think of new webinars in the future. We're also trying to develop some climate change web tools that will be useful, so please take some time to fill that out and help us out with that information. There's an archive of our previous webinars online, and this webinar will be there within a week or so. That's located at changingclimate.osu.edu. Again, changingclimate.osu.edu. The next webinar is going to be January 17th. Dr. Galen McKinley from the University of Wisconsin-Madison will be presenting. Dr. McKinley will speak on climate and carbon impacts on productivity, chemistry, and invasive species in the Great Lakes. We'll email all of you when registration is available. So thanks again, Bruce, for presenting, and thanks again to the participants. We really appreciate it. Have a great day and have a happy holidays.
Thank you.
It's 13 hours.